Hi, I'm Kara Murphy, and this is Money with Murphy. I often get asked these days, are we in an AI bubble? And it's a fair question, which I'll explore. But I'm also going to tell you why you shouldn't worry about the answer. That is, provided you have a diversified portfolio. So stay with me because I'll show you exactly what happened to diversified investors the last two times a bubble burst. The numbers may surprise you. Transformative technologies tend to produce two things at once: real economic progress and excessive investor enthusiasm. The internet, for instance, ultimately changed the world, but that did not prevent many technology stocks from collapsing after the dot-com bubble burst. Today's AI boom carries the same mix: enormous promise and genuine risk. The CEO of Google once called AI, quote, more profound than fire or electricity. But the largest technology companies are investing hundreds of billions of dollars in data centers, semiconductors, and computing capacity. This shift has left investors rightly wondering, will these investments pay off? And there is a risk that some of these dollars being spent today will not enjoy the hoped-for returns. And I don't think diversified investors should worry about it. Now, I understand if you're worried about an AI bubble, being told don't worry about it is unsatisfying. So I'm not saying it to be dismissive. I'm saying it because that's what the evidence shows. A diversified portfolio likely has exposure to large companies and smaller companies, U.S. companies, non-U.S. companies, not to mention treasury bonds and corporate bonds. With that, you will own AI-related companies at the forefront of this boom, plus companies that are active users of AI, plus companies that can win no matter what happens with AI, not to mention bonds that help steady your portfolio. Let's look at what I promised, how diversified portfolios actually performed when past bubbles burst. When the dot-com bubble burst, the technology-heavy NASDAQ declined by nearly 80% and took 14 years to recover. By contrast, a diversified portfolio with a variety of stocks and bonds recovered in just 4 years. We saw that same pattern in 2008. When the housing bubble burst and the financial crisis hit, the financial sector at the heart of the storm fell nearly 80% and took a decade to reclaim its high. A diversified portfolio recovered in just 3 years. And here's the part that people often miss. Recovery time isn't the whole picture. The biggest gains often come in the years just before a boom and in the rebound right after the fall. Investors who sell to avoid the drop usually miss both, which costs far more than the wait to recover. A portfolio spread across many quarters of the market is protected from exuberance in any single one. That doesn't make it immune to declines. Investing always involves risk. But diversification cushions the rocky stretches and positions you to benefit when conditions improve. The takeaway isn't to sell and it isn't to pile in. It's to make sure you're diversified before you feel you need to. With that, and you don't have to know whether AI is in a bubble. That's a far more comfortable place to invest from than trying to predict the future. As always, invest wisely and live richly.